Hello again, we've covered lots of ground on London Direct this week. We've talked Australia, Canada, the ECB and of course oil, but now we're going to turn our attention to precious metals with Chris Beauchamp from IG. Chris, let's frame one discussion in terms of what we've just heard from China. We see gold as this inflation against uncertainty. So what does this announcement mean in terms of if they're going to target lower growth? Is this creating more certainty or not?
I think in a sense it creates more certainty, if you like. Perhaps we've had the downgraded growth target, we've had the PBOC cutting rates. China is preparing the groundwork for looser monetary policy to make life easier, both in political and economic terms, for the Chinese government and the Chinese people. So in that sense, I think we're going to see increased demand for gold. Always tends to enjoy something of a rally when you have central banks easing, and more of that is the likelihood from the Chinese central bank. But you've got weaker growth as well, so they will try and stimulate that, and also inflation rising as well. That also tends to give gold a bit of a lift. So while we haven't seen it really move much at the moment, gold seems stuck to 1200 at the moment. It does look as if the momentum is building to push the price higher.
You've been writing that gold's stuck in a limbo. Is it not just the case that we're dealing with a relatively new economic reality, that this may be a bit alien from the last few years, that the economies around the world are maybe not as bad as they once were, especially in terms of the US, that things are really forging forward?
Certainly there's a lot better data coming through in the US, especially, which leads the way. But even the Eurozone is looking better. Despite the ECB's commitment to QE, we're starting to see real improvement coming through in the first quarter of this year. But even so, central banks around the world continuing to ease, not just the ECB, we've had the Reserve Bank of India cutting rates, China, others around the world continue to do so. So the environment is still conducive for upside in gold. Admittedly, it hasn't got much beyond 1220 really, but that's more to do, I think, with dollar strength than anything else. That won't last forever. I think you'll see a bit of weakening of that as we head towards April. So that gives room, I think, for gold to enjoy not too much upside. It's not going back to the highs of the post-crisis period, but it is going to enjoy something of a lift.
You've also been writing about Brent. Do you think this level of around $60 is well supported?
Well, it looks as if it can hold around 60, but not get much beyond it again. $62 a barrel certainly providing a lot of resistance on the upside. Partially that's a question of weak demand. Although the Saudis have seen an improvement in the outlook for demand, it's still not as strong as it used to be. Even in the US, there's still not that demand that's coming through. So improving economics will help drive Brent slightly higher, but there's still this question of plentiful supply. As we know, the Saudis aren't cutting supply at all.
Yeah, the spread between WTI and Brent is quite large. Brent's been much more volatile than WTI. What's the reason for that, and do you expect that spread to narrow?
Well, in the case of US light crude, we've seen so much more production there, shale gas still coming online across the US, and that is really going to act as a barrier to upside momentum in US light crude. Whereas Brent, we're seeing more room perhaps for an easing back of production, not in Saudi Arabia, but in other parts of the world. In the US, I think it's the oversupply story that really means that US light has little further to go, and you'll see the spread continue to widen.
So let's just finish off with the FTSE, which I know is another one of the areas that you cover. That 7,000 mark's been elusive so far. What do you think it's going to take to push it over?
We'd need to see, I think, a proven in performance in the mining sector. And the problem is with that Chinese cut to the target, the growth target, that makes life a lot more difficult. We're seeing mining firms weaker this morning as a result. But there are other parts of the FTSE 100 that are doing a lot better. Insurance, for example, consumer goods as well, focused on spending in here in the Eurozone and the US, also seeing a bit of a lift. So that is, I think, the key thing that pushes on. But we did eventually get through that previous all-time high at 69.30. So I think 7,000 is still there to be broken. And with QE starting the Eurozone, the liquidity wave is coming our way.
Well, thank you to Chris for his take on events. That's all for the moment from London Direct. Goodbye for now.